Following the Fed's widely anticipated decision to keep its main policy rate unchanged, Fed Chair Jay Powell delivered remarks at the FOMC press conference on Wednesday that broadly aligned with our outlook on interest rates. Despite a likely stalling of inflation in the near term, we still anticipate the equivalent of 2 to 3 25 basis point rate cuts this year. Let's take a closer look. The Fed's updated forecast showed an upward revision of 30 basis points to the median policymaker projection of core inflation for this year. Powell cited higher tariffs as an important factor, with the median projection now showing no further inflation progress in 2025. He noted that the Fed's base case is that the effects of tariffs on inflation will be transitory, as happened following tariff hikes during the first Trump administration. He then remarked that it can be appropriate for monetary policy makers to look through inflation if it's going to go away quickly. While the price stability side of the Fed's dual mandate has played a dominant role in policy decisions since the COVID pandemic, we have long anticipated that the employment side of the dual mandate would play a more equal role in Fed deliberations this year. Powell reinforced this view yesterday, stating that when considering the future direction of policy at this meeting, weaker growth and higher inflation kind of balance each other out. Powell described macro uncertainty as unusually elevated. Among Fed policymakers, the rise in uncertainty was particularly noticeable in their outlook for GDP growth. Nearly all policymakers now see growth uncertainty as higher than the average levels of the past 20 years. This is a remarkable change from the previous projections, when only about half of the policymakers held that view. Powell alluded to tariffs being put on and taken off as a likely contributor to higher uncertainty, which could weigh on business and consumer spending. This reinforces our view that, despite inflation likely stalling in the near term, the Fed appears set to resume rate cuts later this year.